All right, we're going to get started. Good afternoon, everyone. Welcome and thank you for attending our Investment Currents live event, our third call this year. I am Chris Briscoe, Vice President and Wealth Advisor for Girard. And of course, joining me as always, Girard's Chief Investment Officer, Tim Chubb. We're just about halfway through the year and have another great call for you lined up today. But before we begin, we do have our usual housekeeping items. So first, you'll see some disclosures on the screen regarding forward-looking statements and how we reference Girard. So please take a minute to read through them. And of course, just a reminder, this presentation is being recorded. So if you're not able to stay on for the entire call, don't worry about it. You have the ability to watch this again in the future. Just go to our website, which is meetgirard.com. The full replay of the presentation should be available within the week, but there's plenty of additional information on the site that you may find helpful. All right, also, as in past calls, we welcome you to send in any questions you may have. You'll see in the bottom right-hand corner of the screen, your WebEx window, you'll see the QA. All you have to do is click on the QA, and that'll allow you to answer your question, and we'll try to answer it at the end of the presentation. All right, and with that, Tim, the U.S. has opened, at least from my point of view, right? Traffic seems to be back to normal, restaurants are packed, and vacations are all booked. Of course, I could be wrong, but let's talk about what you and the investment committee are seeing right now.
Sure, yeah, and thanks, Chris. Good afternoon, everyone, and thanks for joining us. It's absolutely right. I have my first trip to go see some clients of the firm to Pittsburgh next week since the pandemic where I was supposed to be on March 13th of last year when the whole world shut down for quite a while. So definitely feels good to be back to normal and be in the office a bit more. Hope everyone had a great, nice, long, and peaceful July 4th weekend with family and friends. Like we've done in prior quarters, and as Chris had mentioned, our plan is to really update you on market moves in the last quarter and then highlight a few important themes that our investment committee has been watching and have been a regular subject during client conversations. We'll also conclude today's call with Q&A, as Chris mentioned, and if you're unable to join us and have some follow-up questions that, or perhaps some questions that we couldn't get to, feel free to reach out to your contact at Girard, and we'd be happy to connect with you further. So let's start by recapping the performance of the markets last quarter before we dive into some thoughts on inflation and some other topics. Last quarter, the reopening of the economy supported widespread gains in the financial markets, capping an exceptional first half of 2021 for U.S. equity performance. In the United States, the S&P 500, again, these are the 500 largest companies within the country that are publicly traded, advanced 8.5%, bringing its performance for the last 12 months to nearly 41%. Small cap U.S. stocks, as measured by the Russell 2000, rose just over 4.25% in the last 3 months, bringing its gain to over 62% over the prior year. And again, the market bottomed right at the end of March 23rd. And so a bit eye-popping numbers to see, in the last 12 months. So just obviously, keep that in mind. But coming off of the lows that would be expected. Overseas, indices for international stocks as measured by the MSCI EAFE and the MSCI Emerging Market Index rose about 5.5% and 5% for the quarter respectively. And they now have a positive return for the year and a full year gain of 41 and 45% respectively. Fixed income markets posted modest returns relative to equities, with the Bloomberg Barclays Aggregate Bond Index rising 1.83% in the second quarter, still down 1.6% for the year. And the Bloomberg Barclays Municipal Bond Index trailed slightly, but still grew by about 1.5% for the quarter and is besting the aggregate year to date with a return of 1% at quarter end. Lastly, the 10-year U.S. Treasury closed the quarter with a yield to worst of 1.45%, down from 1.74% from the prior quarter, but up from 91 basis points or 0.9% from the start of the year. Short-term rates of the 2-year Treasury increased from a yield to worst of 16 basis points at the end of the first quarter of 25. And lastly, the 30-year Treasury actually was recently below 2%, but finished the quarter with a yield of 2.07% on June 30th, down from 2.4% at the end of March. And again, yields move inversely to prices in fixed income and in stocks.
Right, and Tim, before getting into some of the economic data with U.S. stock markets hitting all-time highs multiple times in the last quarter, what's your current view on valuations and some of the shifts that we've seen in market leadership during the quarter?
Yeah, great question. Yeah, actually, this was the 18th best start to the year that we've ever seen for the S&P 500 going back to 1926. And so I saw this data this week, and if we were to look at the best 20 years during that, or excuse me, I guess best 20 years in the first 6 months of the year anyway, and just look at how the market performed over that period of time in the following 6 months, it was actually very close to the long-term average. In those top 20 years or top 26 month, first 6 month periods of the year, we saw the S&P 500 rise by about 6.4%, whereas typically we would expect to see from July 1st to December 31st a rise of 6.1%. So we'll see if that's actually the case later this year. I'm a bit skeptical just given how far we've moved both last year and this year. But certainly would be a great surprise to see the S&P and stocks generally continue to climb as the rest of the year continues. And while we have seen the market climb to all-time highs again and again this quarter, there has been a shift in market leadership, as you mentioned, from the first quarter to the second. And looking at the data on this chart as well as on the prior slide, the Russell 1000 Growth Index, which is an index very similar to the S&P 500, but instead of it being 500 companies, it's 1,000 and just growth stocks, rose by about 12% this quarter after basically being flat in the first quarter. Last quarter, the Russell 1000 Value Index, so again, its counterpart, which invests in more cyclical value-oriented companies, rose by more than 11%, but moderated last quarter with a return of just about 5%. And so in the last year, these groups of companies have almost had an identical return, as you'll see. But if you looked at this data this time last year, you would have seen that value and more cyclical-oriented companies meaningfully underperform growth stocks. And generally speaking, value tends to outperform growth during periods of above-trend economic activity and rising interest rates, largely due to the large weighting in financials and bank stocks that would benefit from rising rates. But it also certainly has to do with, just more broadly speaking, in value-oriented companies, the fact that earnings of these sectors tend to be more sensitive to the pace of economic growth. And so, industrials, materials, companies that operate within those sectors of the economy. And since that point, the return differential between growth and value since March 2020 was primarily been a function of earnings growth, and nearly 25% of the return of the Russell 1000 growth was driven by earnings, whereas 13% for the value index. And so we saw growth stocks earnings rise sharply last year. Many of these companies are in the information technology sector, where businesses were actually spending more money. For example, communication devices and the like, getting computers for those who didn't have them to work from home. And so we saw a lot of these companies actually see earnings grow last year and stay extremely resilient, whereas some of the more cyclical and value-oriented sectors, companies like a cruise line within the consumer discretionary sector, obviously underperformed last year in a meaningful way. But now that activity in the economy is picking up very sharply in the first half of the year, we've yet again seen value outperforming as their earnings growth has accelerated, and the trajectory of the economic rebound really has become more clear after the December 6th news about the vaccine being released. And so just decomposing this a little bit more, and I won't beat this to a dead horse, but this slide shows sector performance. Once again, you'll see how distributed the returns have been so far this year. It really hasn't been a rising tide lifting all boats type of market, but one that's been more discerning, more healthy, more selective. And with the extraordinary surge in the U.S. economy and what appears to us is what will likely be a V-shaped recovery, the sectors I mentioned that are more cyclical in nature have performed extremely well year to date, especially in the first quarter again. But we have seen that rotation move back into the growth-oriented sectors in the last several months as we've gotten better data or more data related to inflation and how quickly the Federal Reserve may move in tightening monetary policy. And so while I know everyone on this call knows in our core we're long-term investors and not short-term, sometimes these short-term market moves really create opportunities for patient investors. And so during the last 6 months, our repositioning for clients has attempted to take advantage of these potential opportunities underneath the surface in the market. And while just looking at the S&P 500 generally, all 500 companies in aggregate, certainly the valuation looks more fairly valued at this point. Valuations of many companies within the index actually look more attractive than the index itself, which obviously underscores the benefits of diversification and active portfolio management. We think that elevated valuations will present a challenge for the market as we close out the year, and I do expect the volatility in the stock market to pick up as the Federal Reserve is clear about when they plan on tightening monetary policy and wage pressure to potentially eat in some corporate profits, which we'll get some insight into this week and over the next couple of weeks as we're in the midst of earnings season right now.
Yeah, and you and I were together yesterday, and we talked about the economy a lot, and the no doubt the economic rebound has been extraordinary. And as you were saying yesterday, after the July 4th weekend, TSA check-ins, they're at pre-pandemic levels, and other industries that were hit hardest are either well on their way to a full recovery or possibly there already. This must mean that the U.S. consumer is doing well, right? I mean, after all, we are 2/3 of the economy. So what is the latest on the consumer, and how is the labor market performing?
Sure, yeah. American consumers are happy, and this is a chart of consumer confidence returning. Jobs are certainly plentiful for those who are interested in working, and since March 2020, the American household income has been certainly lifted by the $1.8 trillion in pandemic-related government aid. And so we've seen disposable income rise rapidly in recent months as well as Americans re-enter the workforce, the unemployment rate goes down, and we've seen wages accelerate during this time. And so the most recent jobs report was just a week ago, I suppose, where we saw payrolls, rise by 850,000 in June, which was a little above consensus, really reflecting a continued boost by the reopening and taking the unemployment rate down to 5.9%. It was also reported that Friday that the average hourly earnings rose sharply among hospitality workers, but the economy-wide pace was pretty close to expectations. Wages have actually regained all of what was lost during the pandemic, so they're back at pre-pandemic peak literally in just 8 months. And that was actually has been led by gains in lower paid workers who have actually been very reluctant to leave the labor market, which is why we're seeing some wage pressure there, as there's just so few workers on the lower end of things who actually felt the most brunt of the layoffs that took place as a result of the pandemic. And so to see this recent wage resilience after the most recent recession is definitely a contrast from the global financial crisis, where it took a very long time to see wages actually start to grow, especially for lower earners. And actually, we saw the most wage growth back in the fourth quarter of 2019, right before the pandemic, for these earners. And so I'm certainly hopeful that'll continue as more enter the labor market once some of these benefits start to roll off. Recent survey data from business owners have also have confirmed that they're really hungry to hire workers. And looking at some of the JOLTS reports, there's a meaningful amount of jobs out there open right now. And workers certainly recognize the strength of labor demand. And as employment growth continues to be restrained by some of the lingering pandemic worries, and more of the generous federal unemployment benefits, I think ultimately we'll see later this summer potentially more workers enter the labor market once again. Again, we've seen firms post the highest rate of job openings in about 20 years. And I think these shortages will probably ease again in the next 3 months later this summer as extra jobless benefits expire, schools reopen, childcare gets a bit easier and the like. But that said, there's been about 3.5 million Americans who have actually left the labor force during the pandemic, mostly older workers who might not return and just retire, implying some of the supply-demand gap in the labor market may persist. Payroll report missed in April and May, likely a result of the seasonal effects as well as the benefit-related labor shortages that I just mentioned. And again, really it's huge holes in the bottom end of the pay scale that we're really looking for workers to fill. That said, I actually have 3 jobs open myself at the moment, and it's been difficult finding people really across the board, I think, in this economy. Again, given some of the benefits for unemployment, but also the fact that I think a lot of employers, ours included, are realizing that with the labor force participation rate declining as much as it has, it's extremely important to remain competitive from a wage perspective and obviously keep up with some of your competitors. So again, next few months, we think some of these seasonal factors will ultimately benefit job growth later this summer. and should set the stage for seasonally adjusted payroll gains of around 1 million in the next 3 to 4 months, and likely a notable decline in the unemployment rate and a rebound in the participation rate. I would not be surprised if we saw the unemployment rate. It's currently at 5.9%, get down to about 5% by year end. And thankfully, as more Americans get vaccinated, the pandemic has obviously receded. There will certainly be much less of a drag on the labor market in the months ahead. And I think the most important thing, as I've sort of alluded to a couple of times here, is that I think it's about 25 states last I looked, which actually account for more than 40% of all U.S. workers, will be ending the supplemental unemployment benefits by early July. And these benefits will actually expire for everybody else on September 6th. So in combination, these trends should eliminate most of the current distortions in the labor market and potentially, again, allowing the labor market, or unemployment rate rather, to get down to about 5% by the fourth quarter of this year.
All right, so taking that all in, the goal of the Federal Reserve is to see that the labor market achieves full employment and prices are rising, but only modestly. The Fed has had an extremely accommodative policy stance between buying bonds to lower long-term rates and keeping short-term rates near zero. What do you think the timing looks like for the Fed to come off this easy monetary policy?
Yeah, tapering the bond buying, the quantitative easing is definitely front and center. Just to go back to fourth quarter of 2019 for a second, the Fed's goals of achieving inflation of 2% over the long run and achieving full employment, or having an unemployment rate, not too far from where it was back in December of 2019, which is 3.5%. Ultimately, they're going to use their tools like quantitative easing, buying bonds, mortgage-backed securities, and treasuries to help lower long-term rates, to help stimulate the economy, as well as lowering short-term interest rates to help stimulate the economy on the other end of the yield curve. And so Girard Powell, chairman of the Federal Reserve, he's been very sensitive about the messaging as to when the Federal Reserve may start to do tapering to the balance sheet, and so not necessarily buying nearly as many bonds as they once were, and eventually get that down to not buying any at all at some point in time. And so the taper tantrum back in 2013, which is around this time actually, it was in the summer, was really the result of catching the market by surprise that they would start not buying nearly as many bonds. And so the FOMC, the Federal Open Market Committee, that makes these decisions, has explicitly said that they don't want the taper tantrum to occur. They're literally using those words, and so they've been extremely careful with messaging. And so, again, taking a step back a bit, if the economy is getting back on its feet as it is, and we expect GDP for this quarter, for the second quarter that is, to potentially get close to 10%, which is about 1.5% more than where it was in the fourth quarter of 2019. It definitely is a good case for the Fed to begin tapering these purchases and not nearly have as accommodative monetary policy. And so while the June meeting that concluded just a couple of weeks ago really didn't offer much new information about tapering, it did give us some insight into how the committee actually views inflation. And he acknowledged that the FOMC has been talking about tapering. So again, trying to signal a little bit that we're getting a little closer here. But it made it clear that reaching the standard of substantial further progress is still a ways away, end quote. He also added that the FOMC will continue to assess the economy's progress in coming meetings. And ultimately, I think the first hint that we'll see about tapering could come in August or September of this year, followed by some details about issues such as the pace in November, and some guidance about how quickly they intend on on tapering, and then a formal announcement at the December meeting beginning the tapering process in 2022. And so, if you look at the Fed meeting minutes, you look at the called the dot plots, I'm sure you hear in the financial media, it seems to me that this is consensus amongst many of the participants. And so, again, it's highly unlikely that we'll see the FOMC surprise the markets in a hawkish direction on tapering. But the risks do lean towards an earlier start, both because of how well the economy has been performing of late, but also due to the threat that we've seen with inflation and the report that we just had earlier this week. But, I don't think it's necessarily going to come as soon. And while I guess there is a threat, it will probably be sooner rather than later. I think it's highly unlikely, largely due to the fact that until there's just one more employment report before their next meeting, and I think in Fed typical Fed nature, they'd really like to see one or two more, especially given how noisy and unpredictable the data has been recently, especially in the labor market. But raising rates is still a long ways away. Probably will be a 2022 conversation later in the year about when in 2023. There's quite a few participants in the FOMC who think it could be possibly 2024, but ultimately it's going to depend on what Chris said, which is the full employment and having inflation average over time 2%, which obviously it's much higher currently given the most recent report. So I think chances of a Fed rate hike before middle of 2023 is only about 50%. But again, the labor market and inflation will help determine that. And so as a result of this accommodative monetary policy, global liquidity has been abundant in the second quarter. As a result of all this policy, as to be expected, we saw central banks inject $1.5 trillion in incremental liquidity into the financial system. And this backdrop ultimately supported markets, both stocks and bonds, and seeing the bond market supply and demand dynamics ultimately pushing down bond yields and allowing the bond market to recover after the sharp sell-off that we saw in the first quarter quite a bit. So ultimately, I think the Fed's actions and the speed and some of the economic data that would potentially force the Fed's hand could potentially bring some of the market volatility in the stock market and bond market later this year, and will be likely the most, I think, probable cause for a pullback.
Right, and so then closing the loop on the economic rebound, do you think the speed in which the economy is expected to cover this year, do you think it'll ultimately result in a continuation of the prior economic cycle, or is it going to be, will it resemble a new one?
Yeah, that's a great question. The data certainly would suggest that we're probably continuing the prior economic cycle, especially given that real GDP first quarter growth numbers were 6.4% annualized. April data for consumer spending, inventories, and durable good orders sort of reinforced our view that growth was still accelerating during the first quarter, and that the second quarter will probably be the peak. Topping out of GDP growth year over year of about 10%. And so even if we do get a moderation of growth in the back half of this year, we would expect, fourth quarter, maybe, 7.5% based upon some of the models I've seen year over year, and actually up 5% relative to the fourth quarter of 2019, essentially making a full economic recovery from the pandemic recession, even when accounting for normal trend like GDP growth. And so, I think I mentioned earlier, we get 10% GDP in the second quarter, and we'll get that data shortly here. It'll be 1.5% as far as GDP is concerned, higher than what it was in the fourth quarter of 2019. So unbelievable, extraordinary move in the economy to get back reopened and have the strength that it did. And if you look at this chart, it says GDP held up largely by consumers. It's almost entirely consumers. We're 2/3 of the economy, and again, consumption dropped about 43% during the low of last year. And so, that sort of palish big block on the right is a U.S. consumer contributing to GDP, and obviously without that, it really forced the Fed and Congress to ultimately support the economy in such a meaningful way to prevent catastrophe. And so, like I said, I think the most important thing, and one I'm wrestling with all the time, and I think the investment, I know the investment community, as we have conversations about this, is it the start of a new one or the continuation of the last one? And so, while on paper and by definition, this is the start of a new cycle, once the economy began growing again in the third quarter last year, but the economy has definitely had elements of this mid-cycle phase, just given how swift it's been, and again, thanks to this meaningful stimulus plugging that hole. And it's been less so the case outside the United States, where we've seen a lot of major economies really have different trajectories. A number of developing countries have had been inhibited by their limited access, or relatively limited access to vaccines, and therefore has limited their reopening process. But overall, growth and inflation, I think, are likely peaking right now after accelerating into the second quarter, or potentially have already peaked already. And you'll see here recently we've gotten some data from the Purchasing Managers Index, which is obviously looking at manufacturing activity as well as services. And we've seen, things obviously cool off just a little bit since May, but I would expect that to probably go a little bit closer to 50 as the year goes on. And 50 is still an expansionary territory, but overall, I think, likely inflation and growth are peaking or have peaked at this point. So again, GDP this year, probably around 7.5% year over year. And we're trying to look for like a historical analog as to, going through this before as an economy. It's probably the most closest to the post World War II shift to a peacetime economy. Like today, it was kickstarted by a cyclical rebound in growth and inflation. Like today, consumer balance sheets were extremely healthy, and combined with high demand and lag supply, and I think you want to probably talk about inflation soon, definitely created an upward pressure on prices back then. And so ultimately, it's been the same case here. And while the unusual strength, of course, is welcomed by investors and the economy and Americans, again, it could be obviously a sign that a good portion of the early cycle recovery we would expect to see has been pulled forward. And again, I think there's a really strong argument that the U.S. economy is already on the cusp of either entering the mid-cycle where growth will be slow but remain strong and profitability will stay healthy and monetary policy will become more neutral, or we'd be moving past mid-cycle conditions already and into late cycle where peaking growth, rising inflation, tightening monetary policy, ultimately all may be right around the corner. And so, all told, the U.S. might experience the entirety of the business cycle, less than 2 years potentially, but it's probably too soon to say. I'm looking at month-over-month data more often than I'm looking at year-over-year data at this point, just given how unpredictable things have been and how quickly we've come out of this recession as a global economy. And so, I think I joked on one of these. I've said unprecedented and unprecedented amount of times, and certainly is the case when it comes to just where we're at in the market cycle. You often hear the financial media talk about what inning we're in. It's hard to tell right now, just given how noisy the data is.
Yeah, and I have to bring it up because you mentioned it, and I have to bring it up. It's the question that pretty much comes up in every client conversation, and that's whether or not the inflation pressures we've seen, will they be permanent, right? Transitory is the big word right now. Inflation is transitory. But what are your thoughts on this? Will the inflation in the economy and what it's experiencing, will it be fleeting, or is it indeed here for years to come?
Yeah, that's definitely what everyone is trying to figure out right now. And myself and the consensus amongst our investment committee, and we've remained steadfast in this over the course of the last year, is that the inflation, that we're experiencing right now will be transitory. And the recent spike has been a result of a couple different things, but it's really been just the supply and demand mismatch, that's been resulting from bottlenecks in the global supply chain, and obviously a tremendous amount of pent-up demand as the economy reopens. And so, again, the data has been extremely noisy, and even the most accurate economic forecasters have been looking through a lot of these inflation anomalies and some of this economic data, generally speaking. But at some point, these issues will dissipate, in our view, and in time, once again, a lot of the COVID-related disruptions will heal. Inflation is a very, very difficult thing to generate, as we saw in the last economic cycle. But I remain more concerned about how the labor market may contribute to inflation longer term, as opposed to the short-term supply and demand imbalance really being a permanent problem. So I'll get back to the labor market and some of those concerns in a second, but the supply and demand imbalance has had a couple causes. First on the demand side, fiscal support, was shown earlier, retail sales, looking at consumer income, especially the last round of stimulus checks, it's pushed demand for durable goods. And so these are goods like televisions and furniture and technology and computers and all these sorts of things that aren't consumable to levels that are 15 to 25% above pre-pandemic levels. So again, durable good orders have been about 20% above pre-pandemic trend. And again, on the supply side, we've seen production pullbacks as a result of the pandemic. We've seen supply chain disruptions. Semiconductor shortage has been well reported by the financial news, which has constrained auto production and various other things. And obviously problems with global shipping. Global shipping has experienced a number of problems within the last couple of months. And it may seem silly, but there's been a tremendous shortage of shipping containers. I'm sure if you Google shipping container prices, you'll see just how violently the prices have surged as manufacturers are looking to ship things around the world. Suez Canal blockage, again, may seem silly, and I'll never forget seeing that little bulldozer next to that huge ship trying to get it out as the global supply chain basically comes to a screeching halt. But definitely clogged ports, clogged Suez Canal. And we've also seen COVID outbreaks in some of these key ports across the country. And so all these things have slowed delivery and substantially increased shipping costs. Just a little anecdotal story. I'm purchasing a chair. It was the wrong one. I had to ship it back. And I was just curious. I wanted to see what the cost of this would be. It's about a 3-foot package. It was a chair and an ottoman. And I looked on FedEx, and again, they're not a freight shipper, but they wanted to charge us $2,500 to get it back to Portland, Oregon, from the Philadelphia suburbs. And ultimately, we found somebody that was able to be a tenth of the price. But regardless, unbelievable really disruptions within the supply chain that I don't think are talked about enough. Ultimately, creating pricing pressure now that we can't bring supply to market. And so again, the question is when will this diminish? We've seen from a lot of quarterly earnings calls, with CFOs. They expect that things will really start to get much better in the third quarter, this quarter, especially in the appliance side of things, the semiconductor side of things. There's new factories opening. And so also, I think some of the demand will fade as a lot of U.S. consumers in particular will shift less so away from durable goods and more to services and going back to experiences and travel like they once were. And so I think on the supply side and the demand side, we'll see things lighten up quite a bit. And it could be, toward the end of the fourth quarter, we've already seen, lumber prices normalize quite a bit in just a short period of time. So other manufacturing industries, we've seen low inventory levels. And so now that they're operating at above average utilization rates, U.S. and foreign good producers have opportunity to raise utilization rates even further to bring more supply to market, and so ultimately it's created severe pricing pressure, right? And as we saw in this last CPI report that came out not too long ago, just a couple of days ago actually, the June report showed that consumer prices rose by 5.4% year over year. Which was the highest since August of, August 2008, 13 years ago. Hard to believe, but a third of that price increase in the index came from used car prices alone. So of that 5.4%, a third came from just this insane rise in used car prices. I think it was up somewhere around like 10.4%, but just an incredible move. And again, not one that we expect to really linger too much longer.
And that's why I'm not buying another used car for a while. I'll just keep driving my Accord as long as I can, no matter what my wife says.
There you go.
So looking out beyond 2021, what do you see to be the risk for inflation?
Yeah, so I think it's getting back to what I promised I'd come back to, which is the labor market. Inflation could be this self-fulfilling prophecy to a degree, but market measures of inflation expectations also agree that the pressures will be somewhat temporary over the next year or two, and then diminish, in the year to come. I could see inflation moderating to about 3% by the end of this year over year. I think that would be a reasonable expectation, and then likely getting actually below 2% in 2022. But obviously we'll have to see how things unfold with how quickly we can get the supply chain back up and running in the global economy, and just how quickly some of the stimulus effects from a consumer spending perspective ultimately begin to subside. But I do think there's a legitimate question as to whether or not there's enough labor available to address the current market imbalances. And ultimately, the labor market, as we're just discussing, is facing these widespread worker shortages, and reopening services industries will need to hire more workers too. We think these worker shortages will diminish, as I mentioned earlier, largely due to the expiration of the unemployment benefits, helping substantially increase labor supply. And by September, we expect about 5 million workers to lose those extended duration benefits. I might have mentioned that earlier. 3.5 million Americans will lose their $300 a week federal top-up for unemployment benefits, and 6 million Americans will lose benefits from the Pandemic Unemployment Assistance Program. And so while there's plenty of people who have come back into the labor market, have already started to work part-time, There's enormous demand for workers right now, as we'll see in the JOLTS report. It's a little bit of an inside baseball chart, but really what it shows is basically market participants, investors, large, obviously, firms, even meaningfully bigger than ours. And there's something called swap contracts. And so a swap contract is, let's say it's Chris and I. One of us would pay a fixed rate. And so let's say that's me, and I'm going to pay 2% to Chris on over time. And he's actually going to take the floating rate, which is linked to CPI. And so he would have to pay me the net of 2 versus the floating rate. And so these contracts are used a lot for hedging. Ultimately, a large portfolio, a lot of insurance companies use swap contracts, financial institutions and banks. And so what this shows is that market participants are really expecting that ultimately in the next 5 years, inflation will be meaningfully lower than it will be in the next 2. So seeing that jump down like it has is sort of giving you I hope some confidence there that it's not just me and Chris and the rest of the investment committee feeling this way. There's quite a bit of money behind obviously that view as well. And so definitely clear evidence that a tightening U.S. labor market has been adding to this wage growth, though. On the onset of the pandemic, I mentioned, unemployment rate at 3.5% in December 2019. We started to see some serious wage growth pressures in the back half of that year. And so this quick, recovery from the pandemic basically ultimately means much less time for labor market slack to erode wage growth. And ultimately, with the sharp decline in immigration, even before the pandemic, limiting U.S. labor supply and the highly political nature of immigration debate, I think suggests that this trend of not having enough workers could continue for some time. And so all of this points to stronger wage growth in the wake of the pandemic. And conversely, very easy monetary policy could help fuel investment in labor-saving technology, such as robotics and artificial intelligence. And I was actually giving a presentation yesterday at a Chamber of Commerce here locally in the Philadelphia suburbs. And there's a gentleman who has a trucking business that ultimately works with a lot of metals. And he was saying that on the automation side of things, a lot of the products robots and machines that he used rather than a person to punch steel, ultimately, of course, they work 24/7. They don't whine. They don't take breaks. They'll have to go out for a smoke break. And the cost of these machines have gone from $150,000 to about $40,000. And so again, as very easy monetary policy and low interest rates, again, persist, that fuels investment into technologies. Someone like that, and he is, borrowing money from a bank, going out there and buying these machines, ultimately, frees up another person to go take one of those jobs that are so abundant in the market right now, but are ultimately deflationary. And so the most important thing here is while, the labor force participation rate is seeing levels that we haven't seen since the early 1970s, the deflationary forces and the investment that we've seen many companies make and take advantage of low interest rates, borrowing to further the business and reinvest in it long term, ultimately could become deflationary and offset a lot of the tailwinds that we could have by this labor market mismatch as far as supply and demand is concerned. So again, bottom line, we think risks of higher inflation like we're seeing currently likely going to be short term, but we'll be watching very carefully about the labor market to see if ultimately this mismatch where there's not enough workers, there's plenty of jobs, creates wage pressure much more quickly in the economic cycle than we would normally think.
Yeah, we'll be watching and more to come. So with that, a lot of information. It's time for Q&A. So we have a couple questions here. So please, if you have a question at the bottom right-hand corner, there's the Q&A. Just click on that, enter your question. You ready, Tim?
Ready.
So here's the first one. With the massive deficit spending that's going on, the U.S. dollar will continue to be devalued. How can a retiree with limited earning capacity protect his or her accumulated wealth? Is there a major role for commodity purchasing as well as other hard assets, such as gold?
Yeah, that's a great question. It was actually something a client was asking this morning. I was on a call. When it comes to the amount of money that has been printed, I guess the first thing I like to say is, while me as a fiscal conservative, I certainly haven't liked to see what has transpired. The alternative was so much worse. It was another global financial crisis, and so both Congress and the Fed really had to do what they needed to do and spend as much money as they did. And we could certainly debate, if PPP funds, some of the benefits were maybe too broad in scope, but I think as far as size was concerned, it was absolutely necessary. And as a result of that, we've seen obviously the debt increase in our country. And one thing to keep in mind is it's all relative. And my wife hates when I say that, and I probably say it multiple times a day. But when you look at the size of the U.S. economy, $23 some odd trillion, and you look at the debt load of around 27, we're not too far off from having this balance between 100% debt to GDP. And while it may seem like a lot compared to a lot of other developed countries around the world, like Japan, China, potentially with some of the shadow financing we've seen, certainly Europe and some of those developed countries, 100% debt to GDP is not such an eye-popping number. And ultimately, we really haven't seen investors get spooked at all by what's transpired. And basically, the Federal Reserve is bought up all the Treasury issuance that we've seen last year, to be honest. And so, I think long term, and I've heard clients say our dollar's not going to be worth anything if we keep printing. And I just respectfully disagree, because we have a $23 trillion economy that ultimately can grow and be taxed. It's me and you and everybody on this call that ultimately will help support the dollar from deteriorating quite a bit more. And there's always going to be substantial demand for dollars. Just the pure fact that that's how oil settles, for example, it settles in dollars. And so as far as what to do, gold, if you were to strip out the years coming out of getting off the gold standard, of course the hyperinflationary environment that we saw during the late 70s, early 80s. But if you strip out, even if you keep that hyperinflation environment in the 70s and 80s, and you just strip out after coming off the gold standard, gold has actually not been a very good inflation hedge. And we've seen that so far this year, right? I mean, gold has meaningfully underperformed the stock market, and ultimately hasn't really provided that hedge for you. And so, as a firm, you have to have an investment philosophy and convictions, and to a degree, you have to have a conviction in what what to invest in and how to be successful for our clients. And as I've experienced in my career, it's very difficult to be successful investing in commodities. It's such a short-term tactical hedge, I suppose, for inflation. And ultimately, there's tons of research and data I can send you about stocks being just a great inflation hedge. And so, one of the things too is ultimately, fixed debt. If you expect inflation to pick up, and borrowing from a bank like Univest or others, is a good idea. Is the value of your home would rise, and obviously your debt payment would stay the same. So, probably not something that it's not something that we're considering as an investment committee right now. I think if you're looking at commodities, I've heard from commodity experts, they've said buy physical gold, silver. Ultimately shop around. There's a reason why all these gold commercials are always on. It's because they have a pretty significant spread that they charge when buying or selling that ultimately allows them to afford all those commercials. And so, and as far as silver is concerned, there's a lot more commercial application for silver, especially with electric vehicles. And so personally, I'd rather get the exposure to that opportunity through the stock market. But I think if you're interested, from what I've read and talked to professionals who obviously are much smarter than me when it comes to physical commodities, they say buy physical. So hope that helps.
All right, we have one more question, but just as a reminder, if you have a question, you want to type it in there. It's at the bottom right-hand corner, Q&A. Last question is, how do you see the entry of big money such as BlackRock into residential real estate playing out?
Yeah, I've seen some of those reports. I don't know, to be honest. I'm still, thinking about it quite a bit. We as a country coming out of the global financial crisis have been so underdeveloped as when it has come to housing projects. They are obviously extremely expensive, but extremely time consuming from a permitting perspective. They take a long time to get off the ground. And coming out of the global financial crisis, you might remember, but we almost had a double-dip recession. Europe went through a double-dip recession back in 2011. And so as a result of the uncertainty related to the economic recovery. And while, I guess getting back to the earlier question I was just asked, you think about fiscal stimulus. And I remember, for all those years coming out of the global financial crisis, seeing what the Federal Reserve was doing with monetary policy, stimulating the financial markets. But I kept banging my head against the wall looking for more fiscal stimulus. Now we've got an abundance of fiscal stimulus, right? But getting back to the housing market, as a result of that uncertainty with the economic recovery coming out of the global financial crisis, we just haven't been building homes. And we have this strange demographic barbell right now where baby boomers are ultimately downsizing and moving into homes that, may be considered starters after getting them all fixed up and modern exactly the way that they like. My wife and I live in a suburb of Philadelphia called Westchester, and I think most of our neighbors are in the baby boomer or older generation, as they wanted to be in walking distance to the shops and restaurants and bars and all those sorts of things. And so it's made it very difficult for millennials and Gen Z who are entering the housing market to, ultimately find affordable housing. And so, I think some of the reports may be a little bit overblown as far as BlackRock is concerned. They're not just this evil empire to a degree, but I think the bigger question is can home builders ultimately offset this massive demand that we have for homes right now? And it'll be interesting in particular to see how commercial real estate could potentially be redeveloped. Office buildings like Chris and I are sitting in right now that may be condos or apartments, just given how landlocked some of these areas are for building new properties. But I'll have to get back to you. It's been something I've been thinking about quite a bit, and I just I've read some of the articles commenting on what BlackRock's allegedly doing, but haven't really been able to form an opinion just yet.
All right, that seems to be all the questions for today. So with that, Tim, thank you very much. We're going to wrap up the call today. Of course, we appreciate you all taking the time to join. We thank you for the questions that were submitted, and we hope you continue to find this helpful and informative. Be sure to visit our website, Meet Girard, and until next time, stay safe, stay healthy, enjoy the summer, and let us know if we can help in any way. Thanks.